continuous possession of the product. So we, as collateral controller, behave differently when it is a pure storage agreement or if it is a field warehousing. As he mentioned to you, our main risk is the disappearance of the good, or if the good disappear by the client who bribe one of my inspector. I have declared 100 ton where there is only 50. You don't need to go to credit committee. Thank you very much. Then you have bribed my guy, and the bank give you the money for 100 ton instead of 50. So my job is to make sure that this kind of things don't happen. It's a very, very risky business. But in the meantime, it simplifies a lot of action in terms of you, in terms of credit, etc., etc. A transaction to make a normal loan in balance sheet lending, you can make between 3 to 6 to 1 year to get the credit, where in our condition, you can have that in less than between 15 to 1 month because you are in the seasonal business. But in the meantime, I have to make sure that he has to make sure that when he does a business, he do what we call on jargon, banking jargon, a KYC, know your client, know your client. My job is to look at the KYCC, know your client, because behind you, which the borrower, you have the transporter, the shipping line, the warehouse company, ABCDFG. These people also can jeopardize the asset conversion cycle. Even though you want to really do the business, we have so many cases where because of $1, you choose one transporter vis-a-vis the other. The transporter, especially in certain African countries, is stopped in the road because he wants to ease himself depending on which way he wants to ease. And then as he's easing himself, the good disappear. You lose $20,000. You think that you can catch it back. You try to tweak because you play on weight and quality. And what happened? You get caught or something happened. You lose $60,000, and then the chain go on. Then you cannot pay back the loan. Then the good has disappeared. Then I am responsible. So therefore, we have to make sure that every actors within the value chain are responsible vis-a-vis what they do. The shipping line, the transporter, etc. This morning I've been asked, or this afternoon we have been asked, how we clearing forwarder can be part of this kind of financing. We say yes. Can you issue a true bill of lading? True bill of lading means they are fully responsible of what they receive vis-a-vis the bank. So it mitigates also the transport risk. Thank you.
Thanks, I think that's quite clear. Right. How do we determine the value? I think that's a question on everybody's mind. How do we actually do the calculation and say this is the realizable value of the commodity? There's a number of ways we can do this, and I think every commodity in every country differs. We use the most relevant import or export parity price. How does it differ? In Zambia, for instance, Zambia 5 years ago was an importer of maize. Now it's an exporter of maize. There's an $80 a ton difference if you just realize that connection and make sure the fact that you realize that import parity is more expensive than export parity. Guys, this is a stupid sum, but if you get that wrong, you will lose money. Right, interest rate fluctuations, we talked about the 3%. We found 3% to be fairly okay. I think our average tenure of our deals is around about 270 days. And that's how long our clients hold onto the stock or want us to hold onto the stock before they buy it back. We will naturally finance the discounted value of the commodity, so we work back the cost of carry, and that includes collateral control cost, it includes storage cost, it will include processing cost if there's processing involved. In cotton, for instance, when we buy seed cotton and we put it through a gin, you get lint on the other side. If my client has sold lint and I have bought seed cotton, I need to make sure that there's a tolling arrangement. I can't sell the seed cotton if I've contracted to sell lint. Okay, so there's a processing risk. And I have my collateral controller standing next to the gin and making sure my GOT, which is a gin-out-in ratio, sorry, I don't want to get too technical, but we need to understand the risks of, is it 46%, is it 48%? Because that 2% can make a difference in terms of your risk calculation. Okay. And then the advance made to the client may be secured either by the lender taking outright ownership. That's what we talked about. I take the warehouse receipt, it's now mine, all right? Or by way of taking a first security interest over the commodity. In some countries, like for instance Kenya, banks may not own commodities. It's a legislation thing, we can't get around it. So we take a first security interest. In Zambia, for instance, I can't lease land. So what we do is Zambia has a very forward-thinking way of doing things in terms of agricultural finance. You register a crop charge, which is what they has installed as a matter of taking security for a bank. It's actually registered, very good form of security. Okay. All right, what we do is we set the stop loss. We talked about the Reuters live link that we use. That's normally 90% of the commodities import or export parity price. That's not the price that I finance at. I finance normally about 80%. Why the 10% difference? Why not the stop loss at 80%? Because when the price hits 90%, I need time to get out of the market. So when I finance at $100 a ton, I would set my stop loss at 90 and I would give the client 80. All right. Difference, that $10 is my time to react. So when the price hits 89, I would ask my client to give me $1. He needs to make sure that I stay at that level. If he doesn't give me $1 before 12 o'clock the next day, I phone up traders and say, I've got stock at a discount, are you interested? Okay, because remember, I only bought at 80. So I've got $9 to play with at that point in time. That's the basis of how this works. So I don't have an end buyer, but I build in buffers to play with. Okay. Right, we talked about the option. And also important is, because of the fact that this is my security, I want to give my client flexibility. If he gets a better deal tomorrow, and he gets a sale price for 120 instead of 110, I want him to be able to buy the stock back from me at 80 plus the interest for 1 day. He gives me the 81 or whatever the case might be, and he can go and sell the stock at 130. So it's a very flexible and fluid system of buying and selling commodity. And I don't actually put chains and shackles around my client's business to make sure my security is intact. It's not what we intend to do. Okay. Right. Import finance, guys, is very simple, and I know I'm standing between you and dinner. Basically what it is, it's just an add-on. There's a transport arrangement on the right-hand side there where a carriage agreement is entered into between the importer and the transporter. And basically what happens is I take a session of that, because remember the stock is now mine. So the transporter is actually obliged to deliver the obligations and the terms of the carriage agreement to the lender. Okay, so I've got insurable interest now. Again, it goes back to the insurance. I pay the premiums to make sure the policy is active and intact. Because it's my stock, my insurable interest. If something happens to the stock, either in transit or in storage, I need to be able to go and claim. All right. It's an extension of the warehouse lease financing product. We talked about that. Cages for the shipping and transport legs. And what that does, it actually adds another obligation onto the collateral controller, because he now needs to be at the port, at the point of loading. And it even goes further than that. He needs to be at the point of discharge, at the port destination, to actually give me the assurance that I don't need to claim, because what went into the ship in Mombasa is what came out into the port in Mumbai, for instance. All right. Import finance cages for the financing of trader, which sources the commodity from various suppliers internationally, ships and transporters into the importer's pre-approved warehouse. Again, I've got my collateral controller at the port. If it's a bonded warehouse, he will be there and make sure that bonded warehouse is, in terms of customs, suitable for the product that I want to store there. Okay. So if I finance frozen mackerel, it can't be a warehouse on the port in Lagos without refrigeration. Okay, so my stock will have a problem in about 2 days' time. Right. Just the implementation and transaction flow. Sale agreements entered into. Agreement may require for the importer's bank to issue a letter of credit. Normal trade finance terms. Incoterm is irrelevant here. Right, it doesn't really matter, because I will use my collateral controller if it's FOB up to port of loading. If it's CIF, I will use the collateral to the port of destination. So it's an easy thing to just work around in terms of letters of credit. We don't complicate the issue with the Incoterms. Importer, naturally, importer collateral manager to overlook the entire import process, okay, together with the bank. Very important. And quality and weight certificates are issued. We talked about that. Naturally, designated storage site. I need to know where the stock is destined to. All right. So in terms of the sale agreement, that point is there. I need my collateral controller to be there when the stock arrives. Otherwise, we sit with a thing that's called in situ stock. Okay, and that is where I expect my collateral controller to take over stock that's already in storage. He hasn't been there for loading. He hasn't been there to count the bags. He hasn't been there to weigh the stock. And it's a massive increase in risk for him. And naturally, his price normally indicates the difference. But also in terms of in situ stock, the bank has a risk. there might be fraud involved here. And we've seen it over and over again where